Hi, Katie. Welcome to the Native Angelino podcast for our third interview. Happy to have you.
It's good to be with you, Tom.
It's so good to see you. So maybe just starting from the top, if you tell us about your firm a little bit. I know you've got a few product offerings, and maybe we'll just start there.
Strategies. We're based in Connecticut, and we are, I'd say at its core, it's an independent research provider, and we focus solely on technical analysis research, which is the study of price and sentiment as it pertains to public markets. So we're analyzing trends, supply and demand, but doing so really strictly from price. And it's something that serves as a stuff for a nice unbiased view on markets, almost mathematical and,
Yes.
well, mostly unbiased. Sometimes my biases get in the way. But we do our best to, keep it pretty balanced in the way we're presenting it through a whole suite of research. So we provide research to individuals, to advisors, to large institutions. We do that, I'd say probably about 10 times a week. We're publishing a research report, and they cover everything, every asset class through sometimes ETFs, which of course are very tradable. We'll cover equities, fixed income, commodities, currencies, and we try to make it very actionable and consistent and professional. And then we also have an investable product that sort of leverages our methodology that comes through the research, and that is the Fairlead Tactical Sector ETF, or TAC, T-A-C-K. We launched that ETF in 2022, so it did surpass its 3-year track record. We're very proud of that. It's a very long-term focused fund that uses tactical asset allocation to manage risk, and also, of course, is looking to benefit from sector rotation and trends. Right. We think this is a year in which we'll see more sector rotation than we have for the past couple of years. So it should be pretty interesting.
Thank you. Let's start there, and from the very kind of historical and top-down perspective. As I speak historically, I realize that you have known me, or I've known you, since long before I had gray hair. So it's a long time.
Still recognize you, though.
Yeah. Tell me, what has changed over those 25 years in terms of how you look at the markets, how you do your business? Obviously, the tool set has changed with technology.
Yeah, for sure.
How do you look at that?
I mean, I would say like the access that we have now to a broader tool set, but also broader market inputs because of the technology. So it's been great, because it used to be that we're charting things by hand, literally. Now we have such capacity. So that increased capacity is such a gift, especially for technical analysis research, which is, because it's only price based, it really is in a way very surface level analysis. So I can scroll through 100 charts and have an opinion on them in a matter of an hour, right? So you can really have very high capacity to cover various markets.
And how long would that have taken when you started your career?
Oh gosh, Tom, I don't know, a few months. I know that's an exaggeration.
No, but it really is of that scale, correct?
Yeah, I mean, I used to hand chart using the newspaper, the point and figure charts, which I don't use anymore. So thank you to technology, right, for that capacity. And of course, it's very integrated in what we're doing. We're big users of Bloomberg, and we have a couple other charting software. Right. And that's our primary sort of basis for our analysis. And so we really are very visual in what we're doing, but also somewhat quantitative in the output that we put out to investors depending on what their demands are. So we try to aggregate data and then collect it in a way that people can make decisions, better informed decisions about the markets.
Speaking of price and valuation broadly, if you take over the last decade or two, through my eyes, it appears as though valuations have stretched quite a bit. Is that a fallacy, or is my gut?
You can see it, right? You can see the price trend having extended itself in a way that's pretty unusual. It feels like it's been almost uninterrupted of late. And by all means, in April, we had signs of downside exhaustion to suggest that global equity markets would bounce back. And often those bounce backs are pretty dramatic, because they're counter trend moves. People feel like they're missing out. There's some short covering. There's all sorts of influences to contribute to that. But this one just kept going. So it didn't stop. It didn't lead to a lower high for the major indices. In fact, they've just reached new highs. And just simply by looking at the charts, you can see that steep nature of the up moves. You can't help but feel like things are maybe a little overdone. But this is where the charts and the indicators that we use can come in handy. They can tell you historically, is this a setup that is actually indicative of a big correction or reversal. So we have indicators that take some of the guesswork out of it, but it's in how you combine the indicators that you usually are accurate or not.
All right. So where are we? Are we set up for a big
That
correction?
is the question.
And if we were to see that correction, are we talking 5% or really a 20% plus?
We were calling for a retracement, but whenever you see a breakout, it really overrules the indicators, because the indicators that we use, these are things like moving averages of price, the MACD, which is moving average, convergence, divergence method, stochastic oscillator. These mathematical tools that we use are all derivatives of price, right? So you want to honor that price action first and foremost. So when you see the breakouts, you do want to believe them and let those guide your decision making. So when we saw the breakouts, and those breakouts were confirmed, so they held for a couple of weeks, we felt that the overbought readings that we had in some of our indicators were effectively negated, at least negated for now. It doesn't mean we can't see 20% downside, but it minimizes the possibility of that happening in the near term, because breakouts by their nature generate additional momentum. They relieve the charts of resistance, and they act as a bit of a catalyst for more upside.
Momentum feeds on itself.
Right. And it could just be that fear of missing out that is driving it. This is the frustrating part, I think, for most everyone. It doesn't always make sense, right? Why the market still goes higher or even goes as low as it did in April. These moves are exacerbated by a lot of forces that the average person cannot measure, right? Whether it's ETF flows or derivatives products contributing to it, high frequency trading, who knows what it is. But it does feel like the market dynamics are such that the moves that used to take, I guess weeks now take days. So there's been a real time compression. And I think it's probably related, going back to your question about technology, to exactly that, right? The access to information has been beneficial, but it also has certainly affected the market dynamics. It doesn't mean our indicators don't work, but it does mean that we're very quick to honor stop losses in a way. So most of our sell signals that we'll receive have automatic stop loss levels above which things are probably just going to keep going. So we're very grateful for these indicators to take out some of that emotional bias.
Am I hearing you say that the tool set works even though we have increased velocity of money and trading and all of this? It just requires you and your team to be a little bit quicker to adapt.
Yeah, and I think that, technical analysis, I'd say, never stops working. It is, but you have to adapt to the environment at times, in the same way that you would treat indicators a little bit differently in a trading range environment versus an uptrend or downtrending environment. So you have to have that part of it right. So knowing the environment, and then you have certain, I'd say, metrics you apply with that in mind. I'd call it user error. If you feel like it's failing, or it's usually in how you're combining the indicators. That means that you're on the wrong side of the tape. The indicators have maintained their integrity, in my opinion, throughout all these environments. It's just a matter of, do you have your sort of finger on the pulse of the current environment, and are you honoring the right things? Are you honoring the breakouts or breakdowns? Are you honoring the buy signals and sell signals in the way that you should?
I'm sorry, it sounds a little bit like an arms war between your ability to gather data, sift through it, versus those who are affecting trades and putting money to work in a very rapid fashion. Let's put it that way.
Yeah, we don't want to fight the trend. So we don't spend as much time trying to understand why something's happening as we do trying to understand what is happening. Is supply overwhelming demand or vice versa? And are we seeing breakouts in certain segments of the market? Ideally, you can reconcile that kind of information with macro data, fundamental data. Not always the case, but ideally over the long term, it does make sense, right? Where treasury yields are currently trading, that type of thing. But it doesn't always make sense. So we try to make sense of it through trend and momentum and factors like that. And then we let the macro strategists and the fundamental strategists try to make sense of it otherwise.
So without predicting macro, if price and momentum are the sort of underlying to the discipline, which of these macro factors, interest rates, the dollar, what 2 or 3 or 4 things do you look at most heavily?
We have in our weekly, like our core weekly research report, we have charts always of crude oil, gold, the dollar index, and 10-year treasury yields. We've let those be our staples in a way on the technical macro front, but we look at them not entirely in a vacuum, but something closer to that as to keep it sort of pure, the analysis. So if I hear something from a macro strategist that sounds really like it makes a lot of sense, and then I go and look at treasury yields and it makes no sense, that it doesn't mesh, I'm not going to change my views. I'm really going to let that chart guide my views as opposed to anything anyone is saying. And that is where I think we can add value, especially to maybe highlight something that doesn't make sense right now, but makes you think a little bit, to say yields could go to 5.25. Okay, let's think through what would be the driver of that. What's the time frame for that type of move? Could that mean something for another asset class? That type of thing. So we want to make people think when we see the momentum out there suggesting something different than what they're believing.
Let me ask them, what do you see in terms of interest rates and the dollar?
The dollar downtrend's pretty obvious, I guess, for everyone. And if you zoom out on a monthly bar chart, you'll see a breakdown there that is pretty meaningful. The oversold condition, it is there, but it often takes months for it to really manifest itself in a major low. So we have an oversold condition, but we don't have any buy signals yet for the dollar, suggesting dollar strength, especially against the euro. So I think we're just in the mode of honoring that cyclical downtrend in the dollar, especially with the corresponding breakout in the euro, and watching for signs of downside exhaustion to suggest that those oversold readings will actually matter, because momentum for now seems to be overruling them. The bounces that we've seen in the dollar index have been pretty, I'd say, lackluster, short-lived, meeting resistance at the 50-day moving average. And so we are going to honor that downtrend until it tells us otherwise. The 10-year treasury yield, it's funny, every day you come in and they're making sense of the move, even if it's completely opposite the headline.
Crazy making.
But what we would say is that the end result of all of that flipping and flopping is a trading range. Nobody really wants to hear that because it feels like a lack of a directional bias, but in reality it is a trading range with a whole lot of short-term volatility. We believe that range for indecisiveness. So, right, because it creates like a tug of war between buyers and sellers or that type of thing. That's how we see sometimes these choppy ranges. But yes, it could also be seen as a balance, right?
On a monthly, is it? It's
on a monthly. You can see it on the monthly best, I would say, on the monthly bar chart. Between about, for the 10-year, I'd say about 475 and maybe 385 is the range. It's a wide range. Within that range, we've seen, I would say, higher lows start to unfold. It almost is narrowing into a triangle formation. If we had to guess that the range will probably resolve to the upside. I say that because I think we saw a secular shift off the 2020 low that was really meaningful. You could go back decades and see a downtrend channel that's now been reversed. And so I'm honoring that as a long-term shift in yields. And usually a consolidation within that context would resolve in the same direction of this new secular trend. But we'd wait for the breakout essentially before positioning for yields to move meaningfully higher. Above that 475 area, 5.25 is the next level of resistance. And that comes not at all from macro analysis. It's just strictly from the chart.
As you know, I'm a follower of your work and I have great respect for it. But I was also raised in a fundamental tradition. So as I take a step back and I hear that the dollar is in a meaningful downtrend and the 10-year is in a trading range with an upside bias, I take those two facts and then I say the broad U.S. stock market is up. Valuations are high versus long-term history. How do I connect the dots there and say it just makes sense? Is it purely just momentum?
Well, it's also, there's been real concentrated leadership from the mega caps, as you know, 2023, 2024, and then again off of the April low. So that is meaningful to the upside that we've seen. They now account for, I read somewhere, and I haven't done the math myself, but something close to 40% of the S&P 500 for the Mag 7 stocks. Pretty remarkable. And it certainly suggests that their valuations are being rewarded. And I think they're coming into earnings season maybe a little bit hot is the way I would put it. doesn't mean you necessarily sell them, but you have to feel pretty darn confident in their fundamentals and their ability to sustain these very steep gains that they have seen. What I think is interesting right now is the comparison of anything growthy versus value. You see the ratios almost look as extended growth versus value as some of these stocks do in price terms. So we're looking for a retracement in that growth value ratio. That's something that would be part and parcel with sector rotation. And we started to see inklings of that as the advanced decline lines have reached new highs. And so we have much better breadth, and that breadth can help a market sustain its rally or uptrend when you do lose maybe that relative oomph that we've had from the mega caps.
If I may, let me ask then, if you take the Mag 7 out of the equation and run the same analysis, have you done that? What do you see? Are the conclusions similar, different?
Yeah. Well, we'll look at equal weight indices to that end, and you see that they've participated, and we really do believe in equal weight strategies, which TAC is. But TAC is an equal weight sector strategy with intention. Well, one, we don't want to look just like the S&P and carry that concentration risk. That's not the design of the ETF. It's designed to be a more conservative long-term strategy, manage risk, but also participate. So with an equal weight sector strategy, you're still getting oversized positions in individual equities by the nature of the funds that we're holding, at least in that regard. So let's say we're holding a technology ETF or a technology exposure. Sure. Well, we're still by default getting heavier Microsoft exposure or Apple exposure. Whereas if you go to an equal weight index that's equal weighting the individual stocks, well, they're giving the bottom of the barrel stocks the same percentage weighting as the best of the best. So we feel more comfortable with kind of an equal weight sector strategy where you're reducing your sector risk, but you're still honoring, I guess, kind of the, the reward that the market has placed on these various companies. We think they'll participate. We think they'll benefit these strategies from their, relatively oversold status. So just like value versus growth, value's underperformed. Now the ratios are showing signs of downside exhaustion to suggest that value will get a bounce. And that would mean probably banks will do even better. They have actually been a source of underperformance, even though broader financials have done better. It's been sort of concentrated to the point of owning the best stocks like a JP Morgan or something like that. But then, more opportunity in cyclical sectors and more opportunity in defensive sectors, including real estate.
So, and speaking then of financials and real estate, if from a fundamental standpoint, higher interest rates generally aren't good for either mortgages, meaning obtaining a mortgage, or cash flows associated with commercial properties, or the ability to refinance or pray and extend, or whatever you want to call it, in all of these sectors. So those elements sort of as backdrop, what do you see in the real estate financial sectors? I don't know if you look at things commercial versus residential, what can we draw?
So we look, of course, at the public market for REITs, and we do invest in it through our ETF. There's an XLRE is the ticker. It's the sector spider ETF for real estate within the S&P 500. So it has large cap REITs as the exposure there, and it's a mix of residential and commercial, et cetera. So we have a kind of swath of the sector in that regard, and it has, of course, underperformed the broader market in the same way, honestly, that other defensive sectors have, including utilities, staples, and segments of healthcare. So it's not out of line with the other more defensive and also interest rate sensitive sectors of the market. Again, right or wrong, that's just what's happened. So we feel that I'd say relatively oversold status of these REITs is pretty interesting right now. And when you look at them, because the market's been so strong, their underperformance hasn't meant that there's breakdowns or anything unfolding, right? So they're actually holding up decently well in absolute terms, despite their underperformance. So the resulting setup on the charts is like trading ranges, consolidation phases, often near rising 200-day moving averages. So we're intrigued by that because they don't necessarily have a positive short-term catalyst yet, but we're starting to see more of that in the lagging segments of the market. I would highlight maybe airlines recently, or casinos, other areas in the consumer discretionary sector, home builders, restaurants, FedEx. So you're seeing these short-term breakouts in lagging stocks that could certainly carry over to the REIT sector. And we're intrigued by that. But you're right to suggest, of course, that they are very sensitive to the direction of interest rates. I've also found that it's not necessarily just the direction of interest rates, it's like the speed with which, so that velocity is good there too. And, I do feel like that matters almost just as much. So now that we're range bound, we don't have a great recent comparison, but I find that it's when you see them accelerating, that's more uncomfortable, almost just by the way it feels, almost irrespective of the level at which it's occurring. Because then once it settles into that level, whether it's 4.5 or with 3.5, then people get accustomed to it. And they just sort of embrace it. Maybe it's a market psychology thing that allows that level to at least, after some initial shock, then be absorbed psychologically by the market.
So let me ask, in something like REITs, where there's a large payout, dividend or whatever it might be, is total return accounted for directly? It's not when just looking at price. I mean, it is in the price of the security. But when we talk about performance, are we missing the return to owner, shall we say?
No, I mean, I think we have to compare everything in total return especially as investors. When we're evaluating them in price terms, we're just looking for catalysts, right? Reasons to own them in price terms. But if you were to own REITs or have a position in XLRE like we do, we are looking at it in total return. And for a diversified exposure, you're going to kind of average out in a certain place. But for some of these real estate companies, I mean, the yield is incredibly high. So even if the trend is sideways or even slightly lower, you're still getting enough of a return to justify a position. And I talk to people about treasuries or fixed income sometimes in the same way, that you're talking about a trading range, but when you add in that yield, well, that's really why you're there anyway. So you definitely want to kind of hedge your views with that in mind.
Before I forget, you do offer a trial subscription to some of the research, don't you?
Thanks, Tom, for saying so. So we, through our website, people can sign up through the contact form and ask for a free trial to the research. Anyone's welcome to it. And we usually do about a month-long trial to get a good sense of what we're putting out. And our goal isn't to predict necessarily where the S&P 500 is going to be. That's anyone's guess, but we're trying to help people know when to manage risk, know when the odds are in their favor in terms of market timing. And so that's our primary goal. And we're always going to cover things from a short and long-term perspective. I know technical analysis gets a reputation as being just for traders, but in reality, it's a very, very good tool for your toolbox if you're a long-term investor as well.
And I'll put a link to your site, obviously, in the description. The technical analysis comment you just made, has that changed over the last couple of decades? More accepted, more understood by a broader swath of investors?
I think so. And if we go back to our history, I think we can validate that, right? Where I had to advocate for the discipline in my early meetings in my career. Now I don't have to do that anymore. Not only do people know what it is, but they can embrace it, even if they don't wholly buy into it in some ways. I think they understand that there are merits to it. I just can't imagine anyone, no matter how they're approaching markets, to buy something without looking at a chart, right? How could okay,
what I'll share with you, and you may know this more than once and fairly regularly, I've told the story of, I was working for an investment bank that is now part of another investment bank. And I recall very clearly early in your career, bringing you into the trading desk. And we went through a bunch of hoops to try to bring a technical analyst on board. And not at that point, but maybe 20 years later, you found your way back to true, yes?
Exactly. It's a perfect example. So you saw it in real time. So that's been a gift. And I think it was bound to happen, by the way, with the growing interest in trading, because that does foster that. And it's a way to understand markets, again, without having to go through the balance sheet and, to really know those companies. So for some people, maybe it's a shortcut in terms of trading, because especially over very short-term timeframes, those things probably won't matter, right? But trends certainly will. Sentiment, behavioral elements of the markets will. So it's given, investors and traders, I think, a great tool to help lend more success and more safety in a way to what they're doing. I do find that in our practice, we receive questions almost solely about technology stocks. Pretty remarkable. So what a great thing because there's obviously that interest. People are very interested in tech and growth, and I understand why. But boy, there's so many opportunities outside of tech and growth. So this is where the charts can come in and help not just manage risk, but to identify opportunities that might otherwise not be on a radar. And we have sophisticated ways of filtering markets for various setups, things like that.
Well, let's take something that is on everybody's radar now, and I'd say there's as much skepticism as love for crypto as perhaps technical analysis saw 25 years ago. What do you see in the crypto markets? Does it segment by, I don't know, just how should we look at it? Segment by those with the biggest name or biggest volume?
Well, we've been focusing in our research, and we've been publishing on crypto for close to 6 years now. So we're pretty comfortable with technical analysis of Bitcoin, of Ether, or Ethereum. And we do a lot of relative strength work, rotational work amongst usually the 10 sort of biggest market cap cryptocurrencies. So that's our comfort level at this time. We always are looking for opportunities also in some of the altcoins, just as a theme or topic to highlight. So that's definitely worth it. Efforts. I think technical analysis is one of the best ways to approach the cryptocurrency market, especially in the earlier stages when it was widely misunderstood, perhaps, and so volatile. The volatility is something that's not easy to navigate, and especially if you're using longer term data. So to have the charts and the indicators to help you make your decisions, I think is really key, and to do it consistently. So we always talk about discipline, and we say that and we really mean it, because we think that a systematic approach to anything is more rewarding. And so one of the mistakes I think people make with charts and technical analysis is not coming back to the same tools. Those tools will not always set you on the right path, but you start to learn the nuances of them. And indeed, in the cryptocurrency market, having that discipline, I think it creates some safety around your decision-making process. And we found that the support and resistance levels that we look at are very, I'd say, well-defined, but also well-respected by the cryptocurrency market, which is more normal for FX and commodities, anything with deep global liquidity, as opposed to certain segments of the equity market. So it's interesting to see how it's unfolded in that regard. And what we're seeing right now in this space is breakouts, just like in the equity market. So Bitcoin cleared final resistance, and that came from a trading range that had been in place for a while. So we did see the breakout confirm, and then we saw others follow suit or participate in their own way by advancing from a consolidation phase. Almost the same thing we're seeing. Growth versus value. Value is now starting to emerge with shorter term breakouts. But Bitcoin has really been the established leader long-term in relative performance, and certainly has a very strong momentum prospects with this breakout. So we're keen on the breakout. Also,
Does that imply a target? I'm sorry to interrupt.
Yeah, we can arrive at a target of about 134, 135,000 for Bitcoin. And that comes from just simply a projection based on the existing trend. We're assuming that that existing trend has resumed and will maintain something close to its current trajectory. So I think that's
about 10% from here, all else being equal.
Yeah, it's pretty conservative. I mean, listen, it's a target that we've had for a little while, and these things move fast. What we've noticed is that Bitcoin and others, they have a propensity to see sharp up moves usually, and then they consolidate for sort of a prolonged period. And you have to wonder if maybe we see a greater advance that happens a little bit faster, perhaps, than it would in a different segment of the markets. And then we just plateau for a while. But if you can be long-term and you can ignore those plateaus, it's served you well. I do think there's a real place for it in your portfolio. It might be a very small place, but a place nonetheless, because you're talking about an asset class that not only has momentum, but also has provides diversification, right? We have basically a new asset class, and there are at times correlations that are quite high with the equity market, but it's not always.
And gold or crypto versus gold, how do you look at that?
We run all these comparisons, and we've found that the correlations, I don't think they've settled into what they probably ultimately will be over the long term. I'd say it's more tied to the NASDAQ 100 than other assets and proxies that we've used. The comparison to gold, it hasn't really held very much lately. Gold has just not looked back in its own long-term uptrend. But we just are welcoming the diversification that it can provide with those lower correlations, even if it ultimately settles out to be more correlated to one or the other longer term.
And what about the status of gold? Its price target or momentum, what do you see?
Well, the gold momentum has definitely faltered, but more just from a short to intermediate term perspective. So what we're recommending, and we've been very much on board with this uptrend, is that investors keep a tight stop loss, or traders really. If an investor probably could, survive a deeper correction, but we're keeping a kind of a tight stop. I think it's around 3,200 for people that are more sensitive to that, and we're kind
of. Is that gold
looking
denominated in dollars? So that could be part of the reason. Yes.
Yeah, that would make sense. But that correlation too doesn't seem reliable over the short to intermediate term timeframes. This is where we're a little cynical, because as much as these things matter very long term, they don't always hold true for months at a time. So it could be contributing for sure, but we don't depend on that as a relationship. But when we see gold break down, we'll honor that as increasing risk of a more significant correction than we've seen in some time. So we're keen on it. We don't have an upside objective right now. That's impressive because it's already exceeded those objectives. And we just have that same way of deriving the measured move like we did for Bitcoin. So we need a fresh breakout or fresh catalyst to the upside to assign a new objective. So we can't pull these out of thin air. So we're keen on it, but we are sensitive to the loss of momentum.
And as you and I were talking before, I had mentioned a gentleman by the name of Jeremy Grantham and also Ray Dalio. Any thoughts on either of them in the context of just big picture or thinkers of this sort that you pay attention to?
Yeah, listen, they're coming at the markets from a much different perspective. And I really value these perspectives because it makes you think. So in the same way that I'm hoping people might be made to think by, okay, well, treasury yields are in this, major trading range, that type of thing. So I do appreciate that they make you think. And I think right now they're identifying two sort of major things, right? That valuations are relatively high over, versus history, highlighting different environments in which risk was heightened of a bear cycle. I can't say that I agree with that necessarily, but I think it's a fair comparison to go back to these other environments and see what unfolded. We are big believers in riding momentum until it tells us otherwise. So almost like more reactive versus predictive. So if we were to see a loss of momentum that was more meaningful with that kind of commentary, right, then I think, just theoretically, we'd be more inclined to honor that. So that we definitely keep that in mind. And then otherwise, I think it's talking about the uncertainty we have right now in the US, which is definitely real. Like right now, I feel like we have this almost top-down headline risk. And we're just trying to figure out how to navigate that. It used to be that headline risk was for individual companies. Right now, it's the whole country. But and maybe that's contributed to why we've seen some whipsaws in our indicators of late. And again, just having to be respectful of that. So we, this too shall pass, by the way, in terms of market dynamic that we're unfamiliar with. Every time we go through something that's different, we learn from it. And that's what I think also creates the cycles that Ray Dalio talks about too. So this cycle is right now very much an up cycle still for the US, but you do see some relative performance kicking in and among international equity markets. It's pretty interesting. So we've got our eyes on that for sure. I think it's a little too early to suggest that we'll see sustained and prolonged outperformance from international markets, but we're intrigued by, the uptick, at least in relative performance that we've seen there.
So taking a step back then, headline risk that's changed a bit, yet price and valuation has continued to expand. Maybe it's different this time.
Yeah. And I do believe that markets move in cycles, and I believe that there's rotations. So the question right now, I think, is whether if we lose the relative performance from the mega caps or the Mag 7, can the market weather that? So far, so good, right? But if that changes, I think we should really pay attention. That market breadth is key to the sustainability of mature uptrends. And I think that is one thing everybody can agree on, is that even if it's not a maturing, it is a mature uptrend. So with that in mind, we do want to be sensitive to any shifts that look meaningful. And arguably, we had one earlier this year that affected our indicators in a meaningful way, but it could be this different dynamic with the headlines that people are waiting for that binary moment that releases the market to go even farther, right? So there could be, I don't know if you call that the fear of missing out, but these are different market dynamics. But everything that we know, it does boil down to, are you buying or are you selling? Right? And then what does that do to price? So it's the aggregated views of all the market participants that matter the most. And that's why we're paying attention to things like sentiment in addition to momentum.
With that in mind, as we come towards our last couple of minutes, what has been the most interesting question you've received from, let's say, a professional investor over the last month, 60 days, 90 days? Is there anything that sticks out that made you really stop and think?
Well, I do think it's something that we've already touched on, which they are saying, well, technical analysis doesn't work anymore, right? So does it work anymore is sort of the question. And you know my answer because I will be biased in this regard, of course, but it always matters. It really does matter. It's the eye of the beholder is where, the math might not make sense at times, but technical analysis is the identification of trends. And I don't think there's many people out there that would disagree that the market has a propensity to move in trends. You can just see it, right? And we have great tools that can help us smooth out what's noise as opposed to what's real or price action that they can take advantage of. So that's probably the one that's got me going a little bit over the past few months.
Sure. Well, let me add something, and I will republish the conversation. But during COVID, roughly 5 years ago, you and I had a conversation as things were coming apart, and you explained, outlined, and then followed up with a positive bias if A, B, and C fell into place, and they did. And it's been a nice long uptrend, even if it's 5 years. In the scheme of history, okay, it's not decades, but it's been a good 5 years.
It has. And that was an environment in which, it's funny, our longer term indicators treated that as just a correction, not even a bear cycle. So I know everybody has different definitions of bear cycles, but it unfolded so quickly, right, that the impact on the indicators wasn't that of a bear cycle. So it was a really interesting, albeit harrowing and depressing, time to evaluate a different type of market cycle. And we did get through that, right? So
it took the emotion out of the analysis to a degree.
Yeah, and that's the beauty of having a more systematic approach to where what I found, and this was in part the origin of our ETF and its development, because I found that so many people off of that COVID corrective low were very late to come around. And that's just because it's market psychology. It takes time to feel confident again in the markets after you've been shaken as much as an event like that does. So the indicators don't lie though, right? They'll change and ultimately force us to change with them. So I think that's when the indicators flash buy signals after that type of environment, even if it's, against your better judgment in terms of what you know about the pandemic or whatever it is at the time, you should at least, make a note of that, right? And think of it as a potential opportunity. So we don't have, as you can imagine, a lot of buy signals. We had buy signals around the April low, but they weren't ultra long term. So, there's still a possibility that we see that kind of, big sizable retracement that some of the valuation metrics might suggest. We want to be there for the momentum while it's still there, right? And as mentioned earlier, breakouts tend to exacerbate the momentum.
Finally, we talked growth versus value earlier, and I don't want to misread, but were you suggesting that, I realize it can happen one of either way, But if someone is willing to take a little risk, would you buy value here?
Yeah, I think so, because we have breakouts, right? And the breakouts tend to generate that momentum. And then also you have the relatively oversold conditions in the ratios. I would suggest that they can outperform. I think if you have a catalyst, if you have a positive, ideally both technical and fundamental catalyst, right, to take advantage of, that would be a sweet spot for picking up some of the value exposure. So I do think it's timely. And I think the names that look more extended could be a source of funds temporarily. Let them come in, let them pull back and digest, and try to find those opportunities that are leveraging turnarounds and that relatively oversold condition, sort of an unloved area of the market perhaps. And maybe I'll start getting questions about something that's not large cap technology.
Sector ETFs in your range, or specific value names that might fit a positive bias?
Yeah, there's a lot of them. And we don't ever really play favorites on the stock level, but every week we put out probably 6 to 10 individual names that look interesting to us, both long and short, depending on the environment. In our ETF, we do have exposure that is to that sort of value-oriented segment. And we actually reduced our technology or got rid of our technology exposure. So we still have financials. So financials have been working, of course, and discretionary. So we have some of that sort of relative performance there, but we also have taken positions that would leverage that rotation into value. And that includes the defensive sectors that we mentioned before.
And I know that's clearly explained on your website. Where should we send people to take a look at the research and to sign up for the free trial?
Yeah, I would say fairleadstrategies.com. That's the main website. And we also have a fund website, fairleadfunds.com. And investors or prospective clients could sign up either way and just get more information from us. And we're very, very communicative. We do put out a free monthly letter that I author about the tech ETF and its composures. For anyone that's just interested in the ETF, that's something that we're happy to offer them.
Katie, thank you very much. It's great to see you again. Thanks for your time.
Yeah, of course.
We'll talk again very soon.